Okay, first of all, to complete this table, we need to get the first line, cost of goods sold, for each and every month, which is needed for calculating ending inventory, and later on find the replenishment, the purchases inventory value. So we start from cost of goods sold by using previous tables, sales revenue for January, sales revenue for February, to get to cost of goods sold estimated amount. So if you use this to times 60%, what are you getting for January? $918,000, right? What about February? $399,000. Okay, so this is for the 2 months. We have cost of goods sold, 60% of sales. Now for ending inventory, we need to have at least $10,000 worth of inventory, and then we add additional 50% of second month's, the next month's budgeted cost of goods sold. So for January, you already have February's cost of goods sold. You use that times 50% of $399,000. This is the process of getting the answer. You should be able to get $209,500. Right? Okay, so January is easy. What about February? February, again, you need $10,000 at least, but you need to add March's budgeted cost of goods sold, right? So March's sales revenue, you can actually get it from the additional information on top of the table given to you. It tells you that we are selling, we're expecting to sell 4,100 pairs. Each pair is sold at $260. So this is the budgeted sales revenue for March that you can get from the previous lines on top of the table. Once you have the sales revenue, same policy applied to March. 60% of sales is cost of goods sold. So you times 60 to get March's cost of goods sold first. Okay, so that should be $639,600. That's the cost of goods sold for March, and this is useful to get February's ending inventory. So you will use $10,000 plus March's cost of goods sold, half of that. Okay, so after this, you should be able to get $329,800. This would be the budgeted ending inventory for February. Right, so if you have the first two lines, the third line, what we're doing is adding up what is the total value of inventory needs to be set in place in the business for each and every month. So you have the portion that you're expecting to sell out to customer. You have the portion that you're expecting to keep for next month's sales, for future sales. Add the two up, you should get the total inventory required, these two values. And then we compare the total inventory that the company needs against what they have in the beginning of the month to find whether or not they need to make new purchases in the business. Okay, so the third line, you total up the two numbers we just figured out. Now when it comes to beginning inventory, this is testing on whether you know beginning inventory is the previous month's ending inventory. Okay, so this $469,000 is a little tricky to get. It breaks down to, basically it comes from last month's ending inventory, December's ending inventory. So if we want to get December's ending inventory, remember the ending inventory policy is $10,000 plus 50% of next month, which is January's cost of goods sold. So we'll be using $918,000 times 50% plus $10,000 to get to $469,000. This is the ending inventory of December, which is also beginning inventory of January. Now, beginning inventory for February will just be ending inventory from January. So you already have ending inventory from January. Just copy the number to February's beginning inventory. Okay, so if we come back to January again, we're comparing the inventory that we need with the beginning inventory that we had, which again is December's ending inventory. The difference is this value here, $658,500, is the inventory purchases that the company needs to make in January. Okay, so same theory here. We need to have $728,800 of inventory in February, and we had at the end in January $209,500. Compared to 2, we need to make additional purchases of inventory that are worth $519,300. Okay, so again, this table would really transfers to income statement. The number that we need at the end in the budgeted income statement is the total number of those two costs of goods sold. Okay, so earlier in the table we actually had additional column, a total column, where you need to pick for income statement with the cost of goods sold part would be $918,000 plus $399, the two budgeted cost of goods sold for this month. Just telling you that this table, those two numbers, the summary of that will be transferred to budgeted income statement. All the other numbers will be used for additional other components in the budget. Will be used for cash and balance sheet later. And this table, really the tricky cells here are the ending inventory for February, which you're getting from March sales revenue, and also this part here, beginning inventory from January, you're getting from December. Okay, so make sure you understand those two numbers, where it comes from. It can't just be used for looking at January and February sales. You actually have to refer to March sales. The other one you need to refer to February's sales, and also January's cost of goods sold. January's beginning inventory, you need to refer to January's itself's cost of goods sold. Okay, question? All right, so this exercise, what we did was the first two components of budgeted income statement, and then of course we also have operating expenses. Then it completes the entire budgeted income statement. And we want to know what is the budgeted net income at the end. Okay, on the next